Today, we're going to talk about an amazing way for you to earn passive income, and that's through ETFs. You might have heard about ETFs before, but if you want to dive deep into what they actually are, stick around until the end of this video because we'll cover every important aspect. So, what exactly is an ETF? ETF stands for Exchange Traded Fund. It might sound a bit technical, but think of it like this. Imagine a basket filled with different things, like stocks, bonds, gold, or even commodities like oil. When you invest in an ETF, it's like buying a small share of that entire basket. Let me simplify this with an example. Say you want to invest in some of India's top companies like Reliance, TCS, Infosys, and HDFC. Normally, you would have to buy each of these companies' shares individually, which can be expensive and time-consuming. But with an ETF, you can invest in all these companies at once because the ETF holds shares of these companies in its basket. So, what makes this so powerful? An ETF allows you to invest in a collection of companies all at once without needing to buy individual stocks. This means you're essentially investing in a portfolio, and the best part is that you can buy ETFs just like you'd buy any stock on the stock exchange. Now, if an investor wants to invest in India's top companies, how do they know which companies are the best? Nifty 50. This is where the Nifty 50 comes into play. Nifty 50 is an index of the National Stock Exchange, NSE, of India. It shows the top 50 companies in India with the best performance. With just one glance, you can understand which companies might be worth investing in. But if an investor wants to buy shares of these top 50 companies one by one, it can be both expensive and complicated. This is where ETFs like Nifty Bs come into action. Nifty Bs allows you to invest in all 50 companies included in the Nifty 50 at once. The best part? You don't need to buy shares of each company individually. Now let's talk about active and passive investing. 1. Active investing. In this approach, the investor does their own research and buys individual company stocks. This method involves more risk because you constantly need to track market trends and decide which companies will rise or fall. 2. Passive investing. This is where you invest in multiple companies at once. No research is needed. You simply buy funds like Nifty 50 or S&P 500 ETFs, and by doing so, you're investing in all the companies listed in that index. The risk is lower because even if one company's stock drops, the good performance of other companies can balance the loss. Why are ETFs so great? ETFs are a brilliant way to do passive investing because you don't have to check the market every day. By buying ETFs like Nifty 50 or S&P 500, you can invest in top-performing companies and watch your money grow over time. It's a safe, long-term approach to earning passive income, and here's the best part. You don't need to be an expert. Now, let's discuss the three main categories of ETFs. 1. Index ETFs. These include ETFs like Nifty 50 and S&P 500. When you invest in these ETFs, you're directly buying into the index. They are the most popular and simple ways to invest because they offer diversification and lower risk. You only need to invest once, and the fund management takes care of the rest. 2. Bond ETFs. These ETFs invest in government or corporate bonds. They offer lower risk and provide stable returns. If you're looking for safer investments with steady returns, bond ETFs are a great choice. 3. Commodity ETFs. These ETFs invest in commodities like gold, silver, oil, or agricultural products such as tea and coffee. Commodity ETFs can carry more risk since they depend on market fluctuations, but they're a good option if you want to diversify your portfolio. Which ETF is the best for you? The answer depends on your investment strategy and risk tolerance. If you want steady and secure returns over the long term, index ETFs like Nifty 50 and S&P 500 might be perfect for you. If you prefer safe returns with minimal risk, bond ETFs are a solid choice. And if you're looking to add variety to your portfolio and can handle a bit more risk, commodity ETFs could be the way to go. Why are ETFs the best option? So, friends, if you're looking for a simple and passive way to invest without needing to do much research and still get great returns, ETFs are your best bet. They allow you to invest in many companies at once, saving you time and effort while minimizing risk. If you learned something valuable from this video and enjoyed it, don't forget to like and share it. And if you have any questions, feel free to drop them in the comments. I'll see you in the next video. Thank you for watching. Smile. This script is designed to be engaging, educational, and easy to understand while keeping the viewers hooked. It breaks down complex financial topics into simple, relatable terms that anyone can follow.